In today's video, we're going to be taking a deep look into EPR Properties stock, ticker EPR, which is a pretty popular dividend stock for a couple of reasons. It's currently offering a pretty sizable dividend yield of 9.12%, and it also pays dividends monthly as opposed to quarterly. So for people looking to earn a high amount of monthly income, EPR is one stock that I see a lot of these kinds of investors hold all the time. And for a real estate investment trust, it holds a lot of properties that a lot of other REITs don't hold. So let's do some research into this stock and look into their financials to see where EPR Properties is today, and I'll give my own personal opinion about this company. With that being said, let's go ahead and get started. Having been founded in 1997, EPR describes itself as being an experiential net lease REIT. That's because unlike most REITs that own retail stores, offices, industrial properties, or apartments, EPR owns entertainment venues. Over on their website, you can see they own 356 properties, which gives them a total investment value of more than $6.6 billion. Some of the property types this REIT owns includes movie theaters, golf ranges, water parks, ski slopes, campsites, museums, and several other venues. EPR also holds a few private schools and early childhood education centers in their portfolio. EPR currently trades for $36.18 per share, and they offer investors a dividend yield of 9.12%. Their last monthly dividend amount was for a little under 28 cents per share, which they increased back in February of 2022. EPR stock was holding up rather nicely all throughout last year up until August, where their share price fell by a pretty considerable amount. Despite that though, EPR performed much better in 2022 than the S&P 500 did when dividends are taken into consideration. Like I said, there are a number of reasons why this stock is an attractive investment to dividend investors besides the high monthly dividend yield. EPR since their IPO has outperformed the market by a pretty considerable amount when dividends were reinvested. Their properties also have a very high occupancy rating, and on top of that, EPR is a stock that's been getting more buy ratings from analysts over the last year. But even though the idea of being invested in exciting or entertaining properties sounds attractive, we still need to do a lot of research into whether or not it's an ideal investment. I know it's appealing to be invested in top golf driving ranges and then being able to go to one of those driving ranges, but we're building up investments in our portfolio so that we can ideally someday live completely off dividends. And it's important that the dividends we receive can weather all economic conditions or at least not suffer too significantly of a dividend cut when times get bad. So some of the first places that I like to start when doing an analysis of a dividend stock is to look at a stock's dividend history. Even though past performance doesn't guarantee future performance, I still view past performance as like a roadmap. For EPR Properties, we can see a couple things that I think we should be addressing here. From 1997 until 2008, EPR consistently grew their quarterly dividend, but then during the recession that followed, they reduced their dividend amount by 19 cents per share. In 2013, they started paying dividends monthly as opposed to quarterly, so don't mistake this for being a dividend cut. Between 2013 and 2020, EPR continued to grow their dividend, which by 2020 was higher than it was back before the cut in 2008. In May of 2020, the company announced that their dividend was being suspended due to the pandemic. Fast forward 15 months and the monthly dividend was reinstated, but for 13 cents less than before the pandemic. Today, their stock currently pays 27.5 cents per share, which is the equivalent of almost what they were paying back in 2008. Based upon these past results, we can see this dividend stock suffers a lot during poor economic conditions. When we're in the middle of challenging economic conditions, people typically cut entertainment out of their budgets first. Things like vacations, movies, and even trips to the museum are viewed as a luxury when times are tough for consumers, all of which are properties that EPR invests in. With a lot of talk of more economic hardship in the coming year, this has me skeptical as to EPR's future in the short term. The good news though for EPR is that it's always bounced back from challenging situations, which is a big plus for this company. They've also been dedicated to growing their dividend consistently when possible, again another big positive for EPR. Even if the dividend were to be cut by let's say 10 cents per share, it would still be providing investors with a pretty high yield. But I also want to focus on another issue that I think could become a serious problem for EPR. On their website, it states that movie theaters make up the largest percentage of their revenue, which account for roughly 41% of their real estate portfolio. On page 14 of their most recent 10Q report, we can see two of their largest tenants are in the movie theater sector. AMC and Regal make up roughly 28% of their annual revenue, which is a pretty sizable amount for this REIT. It might be no surprise to you that both of these companies have been struggling in recent years. The parent company of Regal Cinemas, which is Cineworld, filed for bankruptcy protection in September. If you Google Regal Cinemas, you can already see some headlines that some of their locations have already started closing. AMC, as I'm sure a lot of us know, is also not in a great position. The company's been posting bad financials for years and they've been closing some locations. There's rumors they might be interested in trying to acquire Regal, but neither side has been willing to acknowledge this. AMC's been making headlines in recent years for their failing attempts to improve their financials with things like a subscription-based service and now spinning off the ticker symbol APE last year. Since the surge created by Wall Street bets back in 2021, their stocks continue to fall and things don't appear to be getting any better for this company. With so much bad news for 28% of EPR's portfolio, it's another reason why I'm so skeptical about this REIT right now. On top of a recession, potentially losing one of these two clients, I think could potentially cause a dividend cut. I don't think it's an unreasonable speculation to make, and I hope I'm wrong. They might not have to, given how much free cash flow this company's been generating recently. But with all things considered, these two issues are leading me to stay away from EPR Properties for at least the time being. To their company's credit though, they have been well aware of the situation that they're facing. In their latest investor presentation, they mentioned how they're currently working to reduce the size of their theater properties in proportion to their overall portfolio and instead want to focus on other areas. Perhaps even more good news for EPR is I think ultimately time will be on their side. According to studies that have been around for a few years, younger age groups including millennials and Gen Zers put a much higher importance on experiences than physical possessions. Unlike Generation X, baby boomers, and the silent generation, all of whom seem to place a higher importance on things like nicer cars, homes, and jewelry, younger generations are putting a much higher emphasis on traveling and experiences. To them, success doesn't necessarily look like driving a Mercedes or owning a sizable watch collection. To them, success is being able to go out and have more fun rather than admiring the expensive art in their homes. This is good news that EPR is going to benefit from in the years ahead from the people with this mindset, but obviously if we're in the middle of a recession, these generations are going to have less money than older generations to go out and have fun. I have been impressed with how this company's been able to maintain itself in the past though. Using a drip calculator, we can see this stock's done much better than the S&P 500 when dividends were reinvested. Over the past 25 years, EPR's provided an average annual return of more than 10% compared to the index's 7.57%. Remember, this is with dividend cuts and 15 months of no dividend payments at all. So I do understand why people like this stock. I will admit that right now I seem to be one of the very few people out there that's currently pessimistic about this company. But even if I were to consider it, I wouldn't do so until much later this year, maybe not even until 2024. I'd want to see inflation completely under control and interest rates not going up any further. I'd also want to see more indicators that consumers are becoming more optimistic and spending more on experiences. I hold REITs that own properties in a lot of different sectors, including retail, apartments, warehouses, schools, casinos, self-storage spaces, nursing homes, hospitals, among others. Do I feel the need to include entertainment venues in my portfolio as well besides casinos? Not really. I also want to make it clear that despite the fact that I think EPR is a riskier holding, I don't see any indication of a dividend cut coming. Their latest financial performance doesn't show any red flags to me that their dividend is going to see a reduction. They've been posting some good free cash flow numbers from their financial statements. But for this company, history's shown that if economic conditions do get worse, then a cut is a very big possibility. Overall, from what I'm seeing, EPR is still in a good place right now, but if the economy gets worse, then I do worry about how big this will impact this company. EPR stock typically falls in share price significantly worse than the market in general when we go through a recession. During the 2008 recession, EPR's share price fell from roughly $59 per share all the way down to $15 per share. It also takes their stock significantly longer to recover from economic hardships. It should be noted that their share price never even came close to fully recovering to its pre-pandemic price, although it is likely that it will eventually recover someday if they keep managing their company as they have been. But with so many other options out there for higher yielding dividend stocks, EPR is a holding that I personally continue to pass up on.